There is a pervasive belief that you need thousands of dollars in the bank before you are allowed to even think about investing. Millions of people keep their savings paralyzed in cash accounts because of this, watching as inflation steadily erodes their purchasing power. This wait-and-save mentality has become the most expensive myth in personal finance. To understand why, we are going to calculate the exact dollar penalty of waiting and prove that the modern price of admission is lower than it has ever been. Sitting on the sidelines to save up for a worthy starting amount results in an active, measurable loss of wealth. We can see the impact of this delay by running a simulation between two variables, starting capital versus time. Investor A starts at age 25, contributing just $50 a month. Investor B follows the old advice, waiting 10 years to save up a $5,000 lump sum before starting at age 35. In this simulation, both investors receive an identical 7% average annual return. By retirement, Investor A's final portfolio value dwarfs Investor B's. A mathematical irony, Investor B put more cash into the market, yet ended up with less. This is compound growth, returns generating returns. Investor A's massive growth wedge simply had 10 extra years to expand. When it comes to the mechanics of building wealth, having more time is a mathematically superior advantage to having more starting capital. You might wonder why anyone would wait if the math is so clear. For decades, high broker commissions and the need to buy full shares made $50 investments practically impossible. That changed in 2019 when major brokerages eliminated trading fees entirely, removing the cost of placing a trade. The introduction of fractional shares removed the last barrier. If a company's stock is trading at $300, you can now choose to buy just $5 worth of it. Modern investing apps have since dropped minimum balance requirements to exactly $1. The Save Up First rule was a product of a technical system that no longer exists. If the technology changed years ago, we have to ask why we still pass down the advice to wait until we've saved a large amount. The legacy financial industry profited from high minimums and complex fee structures, so they never felt a need to update the public's understanding of the market. You can break that cycle today. You can open a brokerage account with as little as $20. Setting up small, automatic weekly contributions removes the friction of having to decide to invest every time you get paid. Directing those small amounts into a low-cost index fund allows a single dollar to be spread across hundreds of different companies at once, providing instant diversification. You can increase the amount of that contribution as your income grows, but the priority is to be in the market rather than waiting for a specific lump sum. Every year spent waiting for a big enough starting amount is a year of compound growth that can never be recovered. The ultimate danger in personal finance isn't the size of your first contribution, it's the delay in making it.